Hello everyone and welcome to the quickfire revision for Ind AS 23 on borrowing cost. This is an important standard and has come in the past in your main exams directly as well as along with other standards like PP and intangibles. So definitely an important standard. So why do we need a separate accounting standard for borrowing cost? Well, that is because borrowing cost is typically a financing cost and hence ideally the financing cost should go to the profit and loss account like you do in your cost accounting. However, in case this financing cost is incurred for a qualifying asset, that is an asset which necessarily takes a substantial period of time to be ready for its intended use, then such borrowing cost should be capitalized. For all other assets or for all other items other than qualifying asset, the borrowing cost should go to the profit and loss account. So for this, we need to understand what do you mean by qualifying asset. A qualifying asset refers to an asset which normally takes a substantial period of time to be ready for its intended use. Now, typically, a substantial period of time is defined as per management. However, if nothing is given, one can take a guidance of 12 months to be a general reference. However, if it's a pure play borrowing cost question where they're specifically asking you that how much is the borrowing cost to be capitalized, you will assume that the asset is a qualifying asset if the question is asking you the amount of borrowing cost to be capitalized. However, for student reference, 12 months can be taken as a guidance for the purpose of capitalizing a borrowing cost. Remember, borrowing cost can be capitalized for assets which can take a substantial period of time. Now, it is possible that these assets are self-constructed, that is, you are constructing a building or you appointed a contractor or a builder who is constructing the building on your behalf. It will be capitalized for assets which are either purchased or constructed on your own as long as they are taking a substantial period of time. However, if you were to purchase a ready-to-use asset, then the borrowing cost will not be capitalized. Like for example, if you were to buy an under-construction house which is going to take 3 years to be ready, it is a qualifying asset. However, if you are buying a house which already has an occupancy certificate, in which case that is not a qualifying asset. Now, a few key points over here will also involve figuring out how do you measure the period? Well, you measure the period of as the number of months the asset ordinarily takes to get ready for its intended use. So typically the asset ordinarily takes around 6 to 8 months. However, because of your inefficiency, you have taken 15 months. That does not mean that the asset is qualifying because it ordinarily takes 6 to 8 months. That is not a substantial period of time and hence this is not treated as a qualifying asset. Now remember, this standard applies to all assets which take a substantial period of time. However, there are scope exclusions. First, if there are assets which are initially measured at fair value, like biological assets, then Ind AS 23 does not apply. Second, if there are inventories, does the standard apply? Well, yes. However, if these inventories are items which are mass produced using largely repetitive processes, for example, wines, then for the purpose of convenience, the standard says we may not apply Ind AS 23 because it will be very difficult to figure out for these lakhs and millions of units of, let's say, bottles of wine which are manufactured, that how much is the borrowing cost for each wine and when does the borrowing cost capitalization stop. So for inventories which take a substantial period of time, we segregate those inventories as those inventories which are manufactured in large quantities using a largely repetitive process like wine, for example, in which case Ind AS 23 principles will not be applicable. You will take the borrowing cost to the profit and loss. And second, inventories which are not manufactured in large quantities using largely repetitive process, like for example aircrafts, for companies like Airbus or Boeing, they are not mass produced and hence for Boeing you can continue to capitalize the borrowing cost if it is incurred for manufacturing its inventory, that is an aircraft. Apart from these, items like financial assets like shares, debentures, etc. are usually ready for use from the day when they are acquired and hence they are not qualifying asset at all. Next, you have borrowing cost. What do you mean by borrowing cost? So we said what is a qualifying asset. Now you come to borrowing cost. Well, borrowing cost has 3 ingredients. First is the interest expense, which is calculated using the effective interest method. One needs to remember that under effective interest, the effect for coupon interest, the effect for discount if any on issue or redemption, the effect of processing fee or transaction charges is all covered and hence you don't need to account for them separately. So the interest expenses as per effective interest are an example of borrowing cost. Second, interest expenses under finance lease earlier or lease liabilities under Ind AS 116 are also examples of borrowing cost. And lastly, exchange differences to the extent they are considered as adjustment to interest cost. So what does this mean? Well, if there is a forex loss, let us say in the earlier year, on the principal component of a loan, let us say you have taken a loan of $100 at the rate of rupees 50 per dollar. Now, at the end of the year, the rate becomes, let us say, rupees 55 per dollar, and hence there is a 500 rupee foreign exchange loss. Typically, as per Ind AS 21, the foreign exchange loss goes to the profit and loss account. However, let us say the rate of interest in the US for this loan is 2%, whereas the rate of interest in India for an equivalent loan would have been, let us say, 10%. In which case, as per accepted economic and finance theories like the interest rate and inflation rate parity theory, it is expected that the countries which have different interest rates will also have different inflation rates and different exchange rates. And as a result, this subpoint tries to figure out the actual borrowing cost. So for example, over here, if there's a $100 loan whose coupon rate is only 2%, on the face of it, your coupon will be just $2. And if the rate at the end of the year is, let us say, rupees 55 per dollar, we will say that the rate, the interest that I'm paying is only rupees 110. Yes, as a matter of fact, the interest that I'm paying is 110. However, if a similar equivalent borrowing was taken in India, this borrowing would be $1,000 into, let us say, the rate when you took this loan, the rate was 50, which means this notional borrowing would have been, let us say, $100 into 50. So this notional borrowing would have been 5,000. 5,000 into, for example, 10% will come to 500. So an equivalent borrowing in India would have costed 500, and hence the interest adjustment is considered to be, let us say, the difference between these two, that is 500 minus 110, which is equal to, let us say, 390. So it is considered that 390 rupees is the savings in interest. What you have saved, let us say, in interest, it is expected you will compensate in the form of exchange rate. So over here, when I look at forex loss or FX loss, the forex loss over here will be $100 into rupees 55 per dollar minus rupees 50 per dollar, and hence the forex loss, let us say, will be rupees 500. So you are trying to say that if 500 is the total foreign exchange loss, out of this 500, 390 is due to interest rate differences, and hence that is also treated as a borrowing cost, and the remaining additional, let us say 110 or so, will be treated as foreign exchange loss. So ideally, if this was not the case, then your only borrowing cost will be 110. This will ensure that foreign currency borrowings, you will typically show a lower borrowing cost because the coupon in the foreign currency is lower. However, the true cost of borrowing is not just coupon over here, because as per accepted economic and finance theories, we expect that yes, you will pay a lower coupon, but then at the time of repayment of principal, rather than paying, let us say, just 5,000 rupees, which you would have repaid in an Indian loan, you would end up paying $100 into, let us say, 55, for example, in which case you will end up paying more on the principal, which is as per the accepted interest rate and inflation rate parity theories that you will study in your CA final SFM. So this is something which has been incorporated over here. So we have given a few steps that you can follow for adjusting this. So 5 steps that we typically take. Step number 1, calculate actual borrowing cost. Second, you calculate the notional borrowing cost considering the notional borrowing and the rate of interest in India. The difference between 2 and 1 will be the interest adjustment or interest savings. Then you find the foreign exchange loss, and then you compare the foreign exchange loss along with the interest adjustment, select whichever is lower, that is a borrowing cost adjustment. The balancing figure, if positive, will be the foreign exchange loss. Your total borrowing cost to be capitalized will be the actual coupon that you are paying, the actual interest, along with the borrowing cost adjustment that is calculated over here. Both of these will give you together to be the total borrowing cost. In the initial years, instead of a foreign exchange loss, in case there is a foreign exchange gain, then the entire gain will be taken to the profit and loss account. The standard on the face of it applies to borrowing cost, and if there is a foreign exchange gain, it is not a cost, and as a result, you will take that gain in the initial years directly in the profit and loss account. This is sufficient from an exam perspective. However, a more complex evaluation can come in the subsequent years where there may be additional foreign exchange loss, like the rate goes from 50 rupees to 55 and now it goes to 58, in which case there is an additional foreign exchange loss, in which case the same steps as we discussed earlier will be followed. However, if the rate goes from, for example, 55 to, let us say, 52, in which case there is a subsequent foreign exchange gain, ideally a foreign exchange gain should go to the P&L account. However, this is foreign exchange gain on the principal for which you earlier thought that you will have to pay 5 rupees more, and hence you consider that as a borrowing cost. So now, instead of instead of taking that entire foreign exchange gain in the P&L, a part of this we can consider as reversal of borrowing cost. So the reversal of borrowing cost in the subsequent years can arise if there is a subsequent foreign exchange gain after an initial foreign exchange loss, or let us say borrowing cost that has already been taken. So in such a case, what would happen is if the rate goes from 55 to let us say 52 per dollar, in which case you will not follow the usual steps. In fact, you will try to find a foreign exchange gain, like the forex gain, the FX gain over here would be for $100 loan, it will be the difference between 55 and 52, that is rupees 3 per dollar, and hence the foreign exchange gain is rupees 300. Now you will compare this 300 with the borrowing cost earlier capitalized. Now in our earlier example, we had taken that your borrowing cost which was capitalized would be the lower of 390 and 500, whichever is lower, that is 390. So we are saying in the past we thought that we'll have to pay 390 more because the exchange rates will change. However, now as you can see, we will not probably need to pay the 390 more because you have not repaid the borrowing, and hence you will look at the borrowing cost earlier capitalized under step number 5. So under step number 5, in our case, let us say earlier capitalized was 390, and hence we will select whichever is lower. So this is 300, and that will be treated as reversal of borrowing cost. Where will this go? Well, exactly where the original borrowing cost had gone. So if the original borrowing cost was capitalized, this 300 will be reduced from the asset. If the original borrowing cost had gone to the P&L, this 300 will also go to the P&L account. So this is regarding reversal of borrowing costs. We have discussed a few examples in line with what is there in the study material in our books as well as in the ICI study material. There is a question on this, and as an extension of this question, we have done a few additional examples in the notes. Okay, then you look at timing of capitalization. When can you commence capitalization? When will you end capitalization? And what if there is a suspension in the middle? So commencement happens at the later of the date when the loan is taken, or the date when the expenditure is incurred, or the date when the activities commence. Later of these 3 dates will be taken as a commencement date. Why later? Because if the expenditure or activities have started, that is the asset is being constructed. However, if the loan is not taken, there is no borrowing cost. Further, if the loan is taken but the asset is not being constructed, again there is no point capitalizing it, and hence you will take the later of these 3 dates. Once the commencement date arises, it is considered that active development on the project has started, and the capitalization will continue till the time substantially all activities that are necessary to get the asset in the ready to use condition have been completed. So once the asset becomes ready for use, capitalization stops. Remember, you don't wait till the time you sell or dispose of the asset. The moment the asset becomes ready for use, the capitalization stops. If the asset becomes ready for use in parts, then capitalization can stop proportionately as and when each part, like each tower, gets ready for its use. However, till before the asset actually gets ready for use, it is possible that the active development on the asset gets interrupted for an extended period of time, like for a lockdown, due to factors beyond the entity's control, that is abnormal factors which are not necessary to get the asset in the ready to use condition. So if the asset was going to take 3 years, and then in the middle there is a lockdown which extends for around 6 to 8 months where work on the asset has stopped, then during those 6 to 8 months you will have to pay interest to the bank. However, active development of the asset is not happening, and hence during those 6 to 8 months, which is an extended period of time where work is interrupted due to some abnormal factors, capitalization of borrowing costs can be suspended. Once the work resumes, capitalization of borrowing costs can resume. Remember, this is to be done only if the interruption is for an extended period. If it is just for a temporary period, then capitalization can continue and no suspension is needed. Next, you have 2 things. Again, just a key point over here, that activities are considered to commence when work starts. It is not necessary that physical construction has to start. Even site planning or technical evaluation can be considered to be commencement of activities. Now you go to the actual accounting, in which case there are 2 types of borrowings. There is specific borrowings, which are directly attributable or directly connected to the acquisition of a particular qualifying asset. Like a housing loan is directly attributable to the acquisition of a particular asset, that is a house, and hence that is considered to be a specific borrowing for the purpose of a qualifying asset. Then what is a general borrowing? General borrowing is every borrowing other than a specific borrowing. That is called as a general borrowing. It is pertinent to remember over here that general borrowings can include every borrowing, which can include debentures, term loans, even working capital loans and bank overdraft. Because the term borrowing, unlike the term qualifying asset, there is nothing called as qualifying borrowings. It is something called as qualifying assets. So even borrowings which are short term can be taken for the purpose of general borrowing. It is not necessary that you have to take only borrowings which go beyond 12 months. Even if it's a 3, 6, 8, 10 months borrowing, that can also be taken. Even if it is bank overdraft, working capital loan, that can also be taken. So when we look at specific borrowings, how will you capitalize borrowing cost? The actual borrowing cost that is incurred, towards the qualifying assets from the commencement date will be capitalized. Now, once the commencement date arrives, you don't really need to bother about how much expenditure is incurred. You will take the actual borrowing cost that you are paying towards the qualifying assets from the commencement date, and from that subtract the income on temporary investment of surplus funds, if any. This treatment is slightly different from the treatment that you do on general borrowings, where general borrowings you don't capitalize the actual borrowing cost that is incurred on the general borrowings. No, you capitalize only based on the expenditure incurred. But specific borrowing is directly attributable to the qualifying asset only, and hence whatever is the actual borrowing cost. Like for example, if your qualifying asset is going to cost you 100 rupees and you have borrowed the entire 100 rupees on the very first day, of which you spend 40 today and the next 60 you spent after 2 or 3 months, in which case for specific borrowings your capitalization will start based on the entire 100. If there are any surplus funds, let us say 60 funds for 2 or 3 months, then income on temporary investment of these funds will be subtracted, and the net borrowing cost can be capitalized. Remember, what can be capitalized is only the borrowing cost, and items like KE, cost of equity, WACC, cost of weighted average cost of capital will not be used for the purpose of capitalization, because you are looking at just the borrowing cost and not just the overall cost of capital. These items are not even recorded in your books of accounts. Next, when we are going to the general borrowings, the accounting for general borrowings is something which I would rate as one of the most important parts of this standard and one of the most important topics that you should intensely try to revise. A lot of questions in the study materials, RTPs, etc., and our materials that you would have done. So you can try to focus on this part. This is the core of the standard, in my opinion. So when there is a borrowing, let's say there is a qualifying asset where expenditure is incurred over a period of time. So let us say there is a qualifying asset. For example, over here, we have put an example over here where there is a qualifying asset where money is spent 20 rupees on 1st April, then 30 rupees on 30th September, and then 50 rupees on 1st of January. Expenditure is spent on various dates. Total 100 rupees is spent, but over time. And this qualifying asset is financed by a specific loan taken on 1st of April worth 40 rupees. And there are certain general borrowings, 10% borrowings and then 15% debentures which are existing. Surplus funds from the borrowings are to be invested at the rate of 8%. So first of all, what you will do is, you will try to find the borrowing cost from specific borrowings. Step number 1, calculate the borrowing cost from the specific borrowing. So we will say that if the specific borrowings is 40, and expenditure is incurred from the very first day, then 40 into 11%, let us say it is taking the entire year, so into 12 by 12, and hence this will be probably 4.4. However, there can be some surplus funds, so this is 40 minus, you have spent 20 rupees on the first day and the next 30 rupees is spent on 30th September, so which means 20 rupees, that is 40 minus 20 is surplus, which will be invested at the rate of 8% per annum. So over here 20 into 8% into 6 by 12 will probably come to 0.8, and hence 3.6 is a net borrowing cost to be capitalized from specific borrowings. Now for general borrowings, you will calculate something called as the weighted average borrowing rate. So over here, when you are calculating the weighted average borrowing rate, you will say that your total borrowing cost will be 200 rupees into, for example, 10%. This is the borrowing cost for the first borrowing which is outstanding for the entire 12 months, plus another 300 rupees into 15%, but this borrowing is taken, let us say, on 30th September and hence outstanding for only 6 months. So this is your total borrowing cost in the numerator divided by your total borrowings. Well, 200 is available for the entire 12 months, plus there is 300 which is available for only 6 months. So we are trying to say that your actual borrowing cost is going to be what, 200 into 10%, that is 20, plus this is what, I think 22.5. This is 42.5. So there is a borrowing cost of 42.5 on a total borrowing of 200 plus 300 into 6 by 12. So this is equal to 350. And hence I think 42.5 divided by 350 comes to around 12.14%. So this will give you your weighted average borrowing rate. For calculating weighted average borrowing rate in general borrowings, you will take the general borrowing cost in the numerator divided by the time-based weighted average borrowings in the denominator. Usually the borrowings are outstanding for the entire year, and hence you take the entire year's borrowing cost in the numerator and the entire year's borrowing amount in the denominator. If borrowings are outstanding for a part of the year, then you will do the adjustment of interest as well as the borrowings for that corresponding part. Now this 12.14% can be multiplied by the with the expenditures which are incurred for the qualifying asset out of the general borrowing. Now the expenditures are 20 rupees on the very first day. However, this 20 rupees we can say is financed first fully out of specific borrowings, and hence nothing is financed out of the general borrowing. The next set of expenditure happens on 30th September, which is 30 rupees, out of which another 20 rupees will be still financed from specific borrowings, and hence the remaining 10 is from the general borrowings, which is at the rate of, let us say in this case, 12.14% into, this will be outstanding for 6 months, and then next expenditure is 1st of January 2012, where you are spending I think 50 rupees or so. So you are spending 50 rupees. However, this 50 rupees has to be from the general borrowing pool. Now, general borrowing can be available for almost the entire year. However, for the qualifying asset, you have used it only for the last 3 months. So into 12.14% into 3 by 12, and this will give you the eligible borrowing cost of around 2.12 if you calculate. Compare this with the actual borrowing cost that has been incurred during the year of approximately 42.5, and hence we will say that your borrowing cost to be capitalized out of the general borrowing will be the lower of the two, and hence your actual borrowing cost to be capitalized, if I were to glance through the steps, the actual borrowing cost to be capitalized will be the borrowing cost under step 1, which is a specific borrowings, and step 4, which is on general borrowings. So the steps that you need to follow is: first, find the net borrowing cost to be capitalized out of the specific borrowings. Second, for the general borrowings, calculate the weighted average borrowing rate. You will not take the specific borrowings again. You will take all the general borrowings that are there during the year divided by the average borrowings that are existing to find the rate per annum. You multiply this rate to the expenditures incurred out of the general borrowing. We have taken this method. Alternatively, at some places people also take the weighted average annual expense and then do the working. Your answers will remain the same. You can follow either of the methods. We typically take each date, you take the expenditure in that date out of the general borrowing into the weighted average borrowing rate into the months divided by 12, as the case may be, and you find the eligible borrowing cost. You ensure that you cannot capitalize more than the actual borrowing cost. So eligible borrowing cost or the actual borrowing cost, whichever is lower, and the amount of borrowing cost to be capitalized will be under step 1, the specific borrowing cost, and under step 4, the general borrowing cost eligible for capitalization. The total of these two will be taken as the borrowing cost to be capitalized. To be honest, this is something which you should practice with sums, and this is where you get the best understanding of various questions. There have been fairly good questions that have come in the RTPs, in exams. It should be tested, but it has not been tested as intensely. But if it comes, this is what I believe is the most probable. Okay. The last part over here involves expenditure. Now again, in your weighted average borrowing rate workings, there is some inconsistency that institute sometimes follows in calculation of the weighted average borrowing rate and applying it, and we have even kept a separate video for certain problems where there is an inconsistency in the WABR. You can refer that. But otherwise, by and large, the workings can be followed by these steps and you should be able to proceed. The last part over here is to figure out what is the expenditure incurred in behind the qualifying asset. Most of the questions that you see, this data has been given. However, what should be a part of expenditures incurred? First, cash payments towards the qualifying asset. Second, some other assets which are transferred, like in a partnership firm, sometimes the partners bring in capital, sometimes in the form of cash, sometimes partners bring in assets. So whatever it is, this money which is coming for the purpose of construction of qualifying asset in the form of cash or in the form of other assets can be taken as expenditure incurred behind the qualifying asset. An important point over here is interest already capitalized. This is relevant in multi-period questions. So like the May 23 RTP question, if you have seen, it is relevant in the multi-period questions where there is more than 1 year. If there is more than 1 year, then the borrowing cost of the earlier year would have already been capitalized, and hence if you want to find the expenditure incurred behind the qualifying asset, if you go to the capital work in progress carrying value or the ledger balance, you will see that the carrying value includes the balances which are for the cash paid for regular expenses like labor, material, etc. But it also includes the interest cost which has been capitalized, and hence the expenditure incurred on the qualifying asset for subsequent years will be your cash payments, assets transferred plus interest cost which has already been capitalized. In most of the questions this does not really apply because you are asked single period questions, and hence capitalization happens at the end of the period. So for the next period, the expenditure incurred would be the expenses which are incurred on regular qualifying asset cost plus the interest already been capitalized at the end of the year. That will be a part of the opening balance for the next year's borrowing cost capitalization. Sometimes you get reimbursement from the government in the form of grant, so you will reduce that because that reduces your expense, or you receive payments from your customers, suppliers, or some parties who have agreed to reimburse the construction cost, in which case you will subtract that and only the net expenditure that is incurred behind the qualifying asset should be considered. So a key point over here that you should remember is while you have to calculate the borrowing cost to be capitalized, you will take the expenditure based on the cash payment, that is a cash outflow, and not based on expenses that have accrued, because it is possible that in the first month there are expenses of 100 rupees towards the qualifying asset which have accrued. However, you have paid only 40. Then your borrowing will be utilized to the extent of 40 only, and hence in case there are expenses which are accrued as well as expenses which are paid, our capitalization ideally should be based on expenses which have been paid. Again, an example on this which is given. And the last part over here is involving borrowing cost in the consolidated financial statements. There's one particular problem which is there in the institute material. If you have done CFS, you will get some understanding. Otherwise, this is a little tricky. This is a little complex. But nevertheless, if we were to discuss the relevant points over here, this is for one specific question in our material. I think this is question 18 in the institute material. Also, it is, you can just refer, there's one particular question where there's consolidated financial statements within which there's borrowing cost capitalization. So in such case, what do you have to do? When you are doing at separate financial statements level, then you will look at the borrowing cost for your company and the qualifying assets that you have. However, at the consolidated level, parent and subsidiary become one and the same. So it is possible that there is one subsidiary which has borrowing but does not have a qualifying asset, in which case there will be no borrowing cost capitalization in its SFS. There can be another subsidiary which can have a qualifying asset but it may have no borrowing, and hence again there would be no borrowing cost capitalization in the second subsidiary's separate financial statements because there is no borrowing cost. But when I prepare CFS, then in the CFS there is a borrowing and there is a qualifying asset. Now throughout the standard you don't have to do one-to-one correlation ever in case of general borrowings, and hence in such a case when you prepare CFS you will see that there is a borrowing, so there will be a weighted average borrowing rate, let us say 10%, and there is some expenditure incurred behind the qualifying asset, that is 100 rupees, in which case 100 rupees into 10% can be capitalized, or actual borrowing cost, whichever is lower, can be capitalized. We will not say that actually subsidiary 2 has spent money out of his own fund, subsidiary 1 does not have a qualifying asset. One-to-one correlation is not required. So when you prepare CFS, if there's a borrowing, if there's a qualifying asset, then capitalization will happen irrespective of how accounting was done in SFS. That is first crucial point. Second point is sometimes there can be intercompany items, like there can be a subsidiary 1 who is a contractor and subsidiary 2 who is let us say an infrastructure company. Subsidiary 1 has provided construction services to subsidiary 2 for constructing a qualifying asset. So for example, subsidiary 1 has spent 100 rupees to construct an asset whose value is 120 rupees, and hence 20 rupees was a profit margin. So in subsidiary 2's books, the asset will be shown at 120 rupees. If it is a qualifying asset, well, then borrowing cost in the books of subsidiary 2 standalone will be capitalized. In subsidiary 1's books, it is like income of 120 against expense of 100, there is no asset that is created. However, when you prepare consolidated financial statements, then the profit of 20 rupees, which is an intercompany profit, will be eliminated, because for the group as a whole, the money spent behind this asset, which is qualifying, but money spent behind this asset is 100 rupees only. And hence, for CFS, the second important adjustment is the capitalization will be done based on the 100 rupees. That is after removing the unrealized profit in the CFS. And lastly, it is possible that there can be intercompany loans. So there can be a parent, there can be a subsidiary, and the parent can give a loan to a subsidiary, and the subsidiary can then give a loan to some other entity. So there can be intercompany loans. It is possible that in the books of the parent, the loan given to the subsidiary is an asset, and in the books of the subsidiary, the loan taken from the parent is a liability. So what can happen is, for example, if there is parent can give a loan to the subsidiary, and parent has taken a loan at the rate of 10%. For example, it's a 10% loan. In the subsidiary's separate financial statements, I've given this loan at, let us say, 15%. For example, this is a 15% loan. In subsidiary's financial statements, this is a 15% loan, and subsidiary uses to construct qualifying assets. So in the subsidiary's SFS, capitalization will happen based on 15%. But when I prepare CFS, this 15 and this 15 will get cancelled. In my CFS, there will be a qualifying asset, yes, and there will be a 10% loan. So capitalization, if any, will happen based on 10%. This is highly complex and best understood once you do it along with that relevant questions. We have just given a lot of examples and the points to be remembered over here for borrowing cost capitalization in the CFS. You can remember that, and hopefully this should help you in your borrowing cost standard. That should be it for today. I hope this video has been helpful. We'll see you soon with another video. Till then, study hard. Good luck. Goodbye. Take care.